The US Stock Exchange has its origins way back in 1792, where 24 stockbrokers came under a buttonwood tree to make the founding document for the New York Stock Exchange. The NASDAQ is the index that tracks the stock exchange, and that came in much later, in 1971. It does not have a physical location. All the trading here happens electronically.
The giants of world technology.
And how long do we all start calling Meta and not Facebook?
Amazon is a leader here.
Recently, I just heard that Netflix. You guys on Netflix?
Google may be the most Googled word on Wall Street today.
The MAANG Companies. With the technology boom of the early 2000s, all top 5 companies came to be disruptors of the tech space. Now, these companies aren't going anywhere because of their sheer size and endurance. But there are other companies that could be the next MAANG. One tenet of the MAANG is their endurance. These are tech giants that have sustained for decades. So it helps to see what stocks show signs of endurance. And what better sign of endurance than to survive a global pandemic and the whole host of issues it comes with. Now, tech stocks were put through the ringer during COVID. Here's why. Number 1, technology came to the forefront and drove tremendous demand in the tech space. During COVID, there were certain kinds of tech-based businesses that drove cyclical demand. B2C businesses like streaming platforms, gaming platforms, edutech, etc. Now, when we re-engaged in the physical world, demand started falling for these. On the enterprise side of these things, the demand was not cyclical. Enterprises realized that technology can be useful to drive productivity. Think Zoom calls. Most of the fall was because of the B2C side of demand waning. Number 2, inflation was running high. The antidote to that was raising interest rates. This impacted assets which are generally held for a longer period of time, like technology companies. People sold their stake or reduced their holdings in technology stocks and went for assets with more short-term potential. So obviously, companies that are not necessarily B2C are a good bet. These are companies that are not dependent on fluctuating consumer demand. This is one reason why the N, Netflix, from MAANG has been performing so poorly. So, 2 takeaways here. A stock dependent on customer demand or a stock that doesn't have strong dependable finances is out of the running. The 2 sectors that show signs of booming in the next 2 decades are cloud computing and AI machine learning. Cloud computing is the delivery of different services through the internet. These resources include tools and applications like data storage, servers, databases, networking, and software. In simple words, think of it like a toy box. You can play with it at home, but not when you go out. Now imagine you have a magical toy box that can be accessed from anywhere, even when you're not at home. You can play with your toys from your friend's house or even from a different city altogether. This is kind of what cloud computing is like. Examples of this include Microsoft's Azure, Amazon's AWS Business, Confluent, and HashiCorp. Now to AI machine learning. These companies pair with software developers and knowledge workers to make them dramatically more productive. Databricks, Snowflake, Nvidia, all these stocks are at a discount right now. Potentially cheap entry points to stocks that will boom in the future. There's an overall industry level limit of $7 billion for Indian mutual funds to invest in overseas securities and funds, and a separate limit of $1 billion for investing in overseas exchange-traded funds, ETFs. The fund houses have already reached this level, with a little breathing space available every now and then when they sell some international shares or when their valuation comes down. This gives you all more reason to start investing in US stocks directly. When it comes to US stocks, any time is a good time to invest. But in this environment, the iron is as hot as it can be. So strike now.